Hello, everyone, and welcome to Capital Budgeting, Chapter 12. This is a really important part, obviously, of the finance course because it's really applicable to what you guys do. I'm sure you're often competing for capital rations when it comes to projects that you would like to see approved by your capital budgeting committee. So let's go. Capital budgeting are those long-term projects that companies decide between with their excess cash. They can be replacements, replacing something that exists, an expansion, which can include a geographic expansion, a product line expansion, a service line expansion, or enhancement, and also full-on new business ventures. You guys are familiar with all of those. So capital projects have increasing risk. Obviously, a replacement tends to be a little less risky than an expansion, which is in turn a little less risky than a new venture, simply because of the relative unknowns. In a replacement project, you've got a really good idea of how one piece of equipment or something performed, and now you're putting in something new. So a lot of the costs and a lot of the revenues are known, whereas a new venture is very uncertain. A standalone project has no competing alternatives. Those ones are fairly easy to deal with, but mutually exclusive projects are more challenging. If you don't do project A, and that then means you can't do project, B, C, D down the line, that has an impact on whether you select Project A. Project A may not look great by itself, but if it leads to a bunch of projects that you really think are going to be great, it's kind of harder to turn down, so it gets a little bit more confusing as to how you deal with it. So we're really going to focus on standalone projects though here, because that's what's mostly done from a capital budgeting perspective, is deciding what gets prioritized for the coming year or 3-year plan. Now, the first thing to remember is we're in finance, right? So we're talking cash flows, cash flows, cash flows, and we want to focus on after-tax cash flows. So the best practice in capital budgeting or valuation, for that matter, they're very similar, is that we're taking after-tax cash flows and we're discounting our cash flows using an after-tax cost of capital. So that's all sort of coming together in a package when we look at capital budgeting. So there's an initial outlay, usually to buy a piece of equipment, invest in some sort of marketing, buy a business, whatever the case might be. And then there are the inflows. What sort of profitability is it generating in cash flows? And there's a termination. The difference between capital budgeting and valuation is when you're valuing a company, they are infinite. So you have to deal with the perpetual nature by calculating a terminal value based on a perpetuity. So if you're valuing a company, you may go out 5 to 10 years, and then in the last year you do a perpetuity calculation to count for all the years beyond year 10. But with capital budgeting, we make it finite, and we say, okay, at the end of the project, we're going to sell that equipment, and whatever we can get from it is our salvage value. So that's how that works. The cost of capital is, as you know, what is our debt costing us in interest? What is our equity costing us in our investors' expected rate of return? And we combine those two things together in what's called cost of capital. And we compare the inflows and outflows of the project as if it's a loan, and we say, okay, well, can we afford it, right? If our outflow at the beginning is X and our inflows coming in are Y, and our cost of capital is like an interest rate on a loan, then is the outflow greater than the future inflows? Or are the future inflows greater than the outflow? And that's essentially what we're trying to figure out when we're using the gold standard for capital budgeting, which is net present value or discounted cash flows. So payback. Payback is a very simple calculation that doesn't consider the time value of money. The net present value is discounting cash flows, which we've tucked into quite a bit, and you've done quite a bit of actually in your time value of money chapter that we covered together way at the beginning. And then the internal rate of return is basically setting the net present value to 0 and figuring out if this was a loan, what would the interest rate be on that loan? What's the return on the investment in the project? And finally, the profitability index allows us to look at projects with unequal lives, and I'll explain exactly what that does. So payback. Payback is just, okay, if I spend $100,000 to get this project going and I'm going to get $20,000 every year back in after-tax cash flows, it takes 5 years to pay back. It's as simple as that. when you are calculating payback, though, there's obviously a nice simple calculation if the payback is exactly on the year, like 5 years times $20,000 equals 100,000. A little more confusing if it ends sort of halfway through the year. So if we have $90,000, right, and that's what we're putting into it, the investment, and then it's $20,000 a year returning, then there's 4 years plus another half a year, right? We always assume that the cash flows are coming in regularly through the year. And so that way we can say, okay, well, if there's $10,000 left to pay back and there's $20,000 going to be paid back this year, it pays back exactly at the midpoint or in 6 months. So that's essentially what we're looking at. Now, shorter paybacks are better. A lot of companies use payback as a screening technique, and they say, okay, if something doesn't pay back in 3 years or 5 years, we're not even going to consider it. Shorter paybacks are better for ranking projects, but often we don't use payback for ranking, we use it for screening, and we say if it's under 5 years, fine. We can think about it and do the net present value calculation, discounted cash flows, IRR, and look at the qualitative aspects. But if it's greater than 5 years, we don't even consider it. It'd be interesting to find out what TELUS does as far as that goes. The payback decision rules on standalone projects says if the payback period is less than the policy, you accept it, and conversely, you reject it. On mutually exclusive projects, you're looking for ones that have shorter payback. Now, here's an example. $200,000 is what's required to invest in this project, and it has equal $60,000 a year cash inflows after that. So we can see that it pays back between the third and the fourth year. That's where we go from negative cumulative cash flows, the very bottom row there, to positive cumulative cash flows in year 4. Because we're getting 60,000 back in year 4 and we had 20,000 sort of owing at the end of year 3, you can see that it pays back 1/3 of the way through the year, or 20,000 divided by 60,000. So now, payback. The problem with payback is there's no time value of money. As you know from discounting and all the work we did on time value of money, that there are time value of money matters. There's inflation, but there's also cost of capital, and payback doesn't consider either of those elements. It also ignores the cash flows after the payback period. It might be slow to pay back initially, and maybe it doesn't pay back for 5 years or more. But all of a sudden, the cash flows rain down after that. Well, payback doesn't consider those. Once it's paid back, it doesn't really consider what's coming after the fact. So why use it? It's quick and easy. Everybody understands it, and it's a good screening tool. Now, capital budgeting. This looks more like your time value of money that you guys worked on so hard. I think it was chapter 5 way back when, and that assignment on the time value of money. And what this is saying is, the NPV, or the net present value of our project, is equal to the negative cash flow at time 0 to invest, plus C1, or the cash flow at the end of year 1, divided by 1 plus K, where K is the cost of capital for the company, to the power of 1 because it's the first period, the first year. And then you can see the next year, C2, cash flow in year 2, we divide by 1 plus the cost of capital squared, and so on and so forth. If the capital inflows are greater than today's value of the inflows are greater than that initial outflow, in other words, if the NPV is greater than 0, we accept it, even if it's just $1 over 0. Now, NPV basically is saying that we're building something beyond the shareholders' wealth. The cost of capital is something that we, in a sense, have to pay back the investors. We certainly have to pay back the creditors, the interest rate, and then our shareholders, we have to return something, at least what they're expecting, in terms of why they invested in the shares. And so we look for projects with NPV greater than the cost of capital so that we can have a return for our investors, but also have excess capital to reinvest in other projects that we want to do. And basically, if it's greater than 0, we accept. If it's less than 0, we reject. And if one NPV is greater than another, we choose that project that has the greater NPV. Here is just an example here of discounting each of the cash flows back and seeing that at the end of the day, this project has a negative NPV, so should not be undertaken. And if you wanted to recreate this is very simple, using the time value of money techniques that you considered, using a cost of capital at 12%. Now, and here's the calculator solution if you want to do it by calculator. It's easier in Excel, and you guys are very familiar with that. Now, IRR is interesting because we get a percentage. NPV, we get a dollar amount. IRR, we get a percentage, which is great. People find that more intuitive, quite frankly, and businesses tend to use IRR quite heavily, even though it has some real technical issues. Now, IRR is the interest rate at which the $5,000 paid out initially yields an NPV of 0, considering the cash flows in year 1, 2, and 3 are $1,000, $2,000, and $3,000 respectively. Now, the calculator solution basically says in this case the IRR is 8.21%. And I can't remember if you go equals IRR in Excel or if you go equals I or equals yield. I can't remember. I don't usually get you guys to calculate IRR in your exam situations because in the past Excel wasn't robust enough. You had to actually put in a guess and it would only iterate 10 guesses. Then you have to put in another guess. It wasn't the best. It doesn't do that anymore. It's better now, but we still shy away from having you calculate IRR in an exam situation for that reason, and also for the technical reasons of why IRR isn't as robust as NPV. So with IRR, we're comparing to the cost of capital. If the IRR of a project is greater than the cost of capital, we say, yes, we're going to go ahead and do that because it's generating a return greater than what that money is costing us. If there's mutually exclusive projects, basically a higher IRR is preferable to a lower IRR. Basically, that's how it works. And so if we take the NPV versus the cost of capital, you can see the horizontal axis occurs at the IRR. Now, technical problems. If some future cash flows are negative, the project can have more than one IRR solution. That's actually, I find this textbook sometimes makes things a little too simple in black and white. The fact is if there's more, if there's a dip again where the future cash flows are negative, you can't actually solve for IRR. It's not mathematically possible. You can solve both pieces of the IRR curve, the cash flow curve, separately, but still that's not really an answer either. So now Excel's actually going to truncate it for you. If you calculate an IRR in Excel and it has a double dip situation where it's negative, positive, negative again, then Excel and then goes positive again, the people at Microsoft decided that what they would do is instead of returning error, which it should do, they will truncate it and they'll calculate the IRR on the first curves that end up at 0 again. So it dips down and you've got your initial negative, then you go up and it's positive. When it dips down to 0 again, Excel truncates it there and calculates it, and it ignores the next downward cycle of negative and positive. It ignores all that. So it actually gives you an incorrect solution. The reinvestment assumption also assumes that it's going to be reinvested at an IRR, the same IRR. So if you've got a project and you're calculating IRR, and you generally have projects that return like 15% because that's typical in your industry and for your business within that industry. If you've got a big project that's 20, 25% IRR, it's generating some really high returns compared to what you would normally return. It's actually giving you an even more magnified false positive to go ahead with that project, because it's assuming that once you've paid back the initial investment and now you're spinning off extra cash, that you're able to reinvest that cash at a similarly high IRR project. And that may be a real one-off project for you where there's no opportunities for that kind of return. So it has kind of a compounding effect, a positive compounding effect that can be very illusory, or maybe even not giving you the right answer. It can indicate more positive results than actually exists. So NPV and IRR do not always provide the same decision for a project's acceptance. Sometimes they give different results, and NPV is considered the gold standard because its reinvestment interest rate is more practical. And so here's an example of where that could be. At cost of capital K1, project A is better than project B, while at K2 the opposite is true, even though these projects are the same. It's just the cost of capital that's changed. NPV profiles cross at a crossover rate. That's the discount rate that makes the NPV of the two projects equal. The best one is the one with the largest NPV, though, just as a reminder. Oh, and here we go. It is IRR. So there you go. In Excel, you can calculate IRR by going equals IRR, interest rate, cash flow, cash flow. Yeah, and I think that's a bit old there too. Anyway, spreadsheet solution. Okay, and there it is. You can see what it looks like if you were to do it in Excel. So many projects have one outflow at time zero and then inflows that represent an annuity stream. So for example, if we say the cost of capital is 12%, 5,000 is being spent, and then we have this nice 2,000, 2,000, 2,000. Boy, that looks an awful lot like investment in a bond, doesn't it? A bond where you invest $5,000 at the beginning and it has interest payments of 2,000, 2,000, 2,000. Now there's no future value of the face value of the bond, but everything else is sort of holding together there. So you can imagine how you would calculate the present value for this particular calculation. You've done it before with bonds. Pretty straightforward to do that. And here is exactly how you would do that calculation. Pretty straightforward, and I'm sure you guys can handle this. Now, profitability index is a variation on the NPV method. It's a way basically of comparing projects with unequal lives. It says take the present value of the inflows and the present value of the outflows and, numerator, denominator, divide them through and come up with a PI. This helps us with, not varying project lives, but varying project scopes. We might have some very big projects, we might have some very small ones, lots in the middle. A PI helps us normalize all of them and be better able to compare one to the next. Basically, if the PI is greater than one, you accept. If the PI is less than one, you reject. And if a PI is greater for A, then you choose A over project B. So that's how that runs for profitability index. The last, I believe, concept that we're going to talk about today is capital rationing. The concepts that every company, including TELUS, doesn't have unlimited funds available for new projects. And so there's a capital ration, and everyone's sort of fighting for it in terms of getting their projects approved. So how do you choose from a set of projects? And the answer is you generate as much NPV as possible. You choose your highest NPVs all the way along until you run out of cash. So here's a good example of you've got a $16 million funds limitation. You've got project A, which has an IRR of greater than 15%. It costs $8 million. So we're going to do that one. It has our highest NPV. We're definitely going to do that. And then our second one has got an IRR of just 14% it looks like. Costs another $5 million. So we've spent a total of $13 million of our $16 million budget. And we can start project C, but we can't finish it. And we're going to ignore, D, E, and F because they don't return the same kinds of returns as A, B, C, A and B, and starting C, even if we can't finish it in this year. So that's the concept of how we ration capital and make decisions between projects running A through F.